This is not financial advice. I'm recording my thoughts about Shopify. Shopify has made it very easy for people like us to start our own retail store with very little investment. Shopify competes with companies like Wix.com and BigCommerce and also Amazon with their new Buy with Prime option. Shopify stock is currently trading at about $320 and with a market cap of about $40 billion. When I look into their past 12 months of revenue, they made about $5 billion, which represents a price to sales of about 8, which is expensive. And when I look at their net income, they made about 180 million, which represents a price to earnings of about 200, which is extremely expensive. The PE of 200 is expected because this is a growth stock and that is growing at very rapid pace, right? But when we look into the stock's performance in the past 1 to 2 years, it went to an all-time high of about $1,400 and now it came down to about $300. The reason for this is that the growth is decelerating for this company. In 2021, they grew their revenue at about 57%, which is extremely good. But if you look into the past 2 quarters, they only grew about 21% and 41% respectively. So the growth is decelerating significantly. For this entire 2022 financial year, they are committing to about 30% growth. In other words, in 2021, they made about $4.6 billion of revenue, but this year, they are only promising $5.8 billion of revenue. That's only 30%. And decelerating growth by about 27% from the previous year is a crime in this current market, right? That is why the stock has come down significantly. So let's look into its evaluation 5 years out, that is 2027 January. So since they grew about 30% this year, I can only assume that they can grow 30% in the next 5 years because of the increasing competition and Amazon's Buy with Prime option, right? So I can only assume 30% growth, which makes their revenue to be about $16.5 billion by 2026 December. This company has consistently made about 50% gross margin, so I can only assume a 20% net profit margin. So with a net profit margin of 20%, they would make about $3.3 billion of net income. Since this is a company that's growing in the 30% range and makes a net profit margin in the range of 20%, I can only assign a multiple of 20. So if I assign a multiple of 20, the market cap in 2026 December would be about $66 billion, which translates into $526 per stock. But wait, the stock is already $320, right? So that's about a $200 gain or 65% gain in 5 years. If I invest in index, I can get close to 50-55% of gain, right? With much lower risk. So it doesn't look like a good risk reward to me, even at $320. But let me tell you this, you can ask me that, okay, if we go by these numbers, we can never invest in growth stocks. And I do agree. So what we can change here is the multiple, because I'm not comfortable changing the growth rate or the net profit margins because I think they will be very close to reality if you follow this company quarter after quarter, right? But we can definitely change the multiple from 20 to 25 because if a company performs consistently, people try to pay up for its growth and they will go up on their multiple that they assign, right? So if I assume a multiple of 25 on the same $3.3 billion of net income, this company would be worth about $82.5 billion or $660 in 2026 December. Currently the stock is at $320, so that's more than 2x in 5 years if we assign a multiple of 25, which I think is not unreasonable if they execute very well, right? So at the moment I'm still thinking whether to pull the trigger on this stock or not. At the moment I do not own this stock, but I will consider if it goes below $300.